Hey guys, sorry I wasn't able to be in class today, but I hope this recorded presentation is a decent enough substitute, um, even though I'm not there to facilitate discussion and questions a little bit more. But today I'm going to be talking about the Airbus dollar exposure mini case that's in our textbook. If anybody hasn't had a chance to look over this yet, I'll just brief it a little bit here. So Airbus sold an aircraft to Delta, which is a U.S. company, and billed them $30 million payable in 6 months. So that's a receivable in a foreign denominated currency for Airbus. And they're concerned about the exchange risk there, and they would like to control that. The current spot exchange rate is $1.05 per euro, and the 6-month forward exchange rate is $1.10 per euro. They can also buy a 6-month put option on US dollars at a strike price of 0.95 euros per dollar and a premium of 0.02 euros per US dollar. And currently the 6-month interest rate is 2.5% in the Eurozone and 3% in the US. So a little bit of background information here. Airbus is a multinational corporation with its headquarters in the Netherlands and an additional major operating office in France. So they are in the Eurozone and they are a Euro-based firm. Delta is also a multinational corporation, but it's headquartered in the US. So obviously its home currency is in fact the US dollar. So Airbus in this case is facing transaction exposure because they have a transaction receivable denominated in a foreign currency and there's unanticipated exchange rate changes there. So with uncertainty, there's risk, and the goal is to eliminate that uncertainty. In this specific example with Airbus, their transaction exposure is the 30 million US dollars that's to them foreign currency denominated. So the first choice here is to hedge using a forward contract. Just a little bit of conceptual knowledge here. It says it wants us, step one is to compute the guaranteed euro proceeds from the American sale if Airbus decides to hedge using a forward contract. So I think we've gone over this a pretty good amount in class so far, but just to touch on it a bit again, we want to lock in at a price that we know exactly what Airbus will pay in 6 months. There's no uncertainty, and so there's no exposure. It completely eliminates transaction exposure in this case. Now you could lose a potential gain with this strategy. It is less flexible than, say, a put option, which I'll talk about a little bit later. The spot rate could in reality be more favorable than the forward rate we're locking in at. So for example, if it's $1.08 per euro in 6 months versus $1.10 that we're locked in at. Now, in terms of the calculations, step one for the forward contract, and I'll put the case facts here to kind of make it easier to keep up a little bit. On day one of the transaction, Airbus will enter into a 6-month forward contract to sell forward that 30 million US dollar receivable to a US bank at the forward rate of $1.10 per euro. In this case, the US bank is the dealer, and thus they are taking the opposite side of Airbus. In this case, they're the counterparty to the forward contract. Step two, or just next down the timeline here, in 6 months, Airbus will receive that $30 million payment from Delta, and simultaneously, its 6-month forward contract will mature, and Airbus will deliver the 30 million that it receives from Delta to the US bank that it entered into the forward contract with. In exchange, Airbus will receive 27,272,727 euros from that US bank. And the calculation there is pretty straightforward. It's just the 30 million US dollars divided by that $1.10 per euro forward rate. And that's just, I put it in red so you can see it's up here. It's the same as down here. And this 27 million value is our guaranteed value here. So number two, if Airbus decides to hedge using money market instruments, what action does Airbus need to take? What would be the guaranteed euro proceeds from the American sale in this case? So calculations here, the concept is fairly similar to what we did before the last test. Money market hedge with a receivable or with a payable, excuse me. But it's kind of just the opposite here. So step one is to borrow the present value of that $30 million in the US at the US interest rate, which again is 3%. You can see down here. So we'll borrow the present value of that. So 30 million divided by 1.03 is going to give us the current value, present value, which is 29,126,214. Step two is to convert that present value that we just borrowed, that amount that we just borrowed, using the spot rate of $1.05 per euro, convert it to euros. And with that, we'll get 27,739,251 euros. And then step three is to then invest that amount in the Eurozone at 2.5%. So the calculation here is just that 27 million amount times 1.0251 plus the interest rate, which is going to get us a guaranteed value of 28,432,732 euros in 6 months. And this, it's important to note that this all happens at t equals 0. So day one is when all of these things are simultaneously happening. So step 4 and step 5 are both 6 months from now. That's important to note as well. As the 6-month period concludes, they will collect the 30 million payment from Delta and use this to repay the initial loan that was taken out at t equals 0. And that loan should now be worth $30 million. That was the idea behind the present value. So just to reverse it, the 29 million times 1.03 again is 30 million. So we're just using what we got paid from Delta to repay that loan that we took out in the US. And at the same time, we will receive the maturity of the euro investment, which is now equal to 28,432,732. And that is our guaranteed euro proceeds in this case. And that's the same value that we calculated above in step 3 right here. So using money market instruments, Airbus again eliminates transaction exposure completely, and it has a greater guaranteed value than the forward hedge. So in this case, it's more favorable. So this 28 million is greater than this 27 million. So if these were the only two options we had, we'd want to go with the money market hedge. Question 3 in this mini case asks us if Airbus decides to hedge using put options on the US dollars, what would be the expected euro proceeds from the American sale? Assume that Airbus regards the current forward exchange rate as an unbiased predictor of the future spot exchange rate. So step 1 here is to go ahead and buy that 6-month put option. So just to reiterate the concept of that, they're buying the right to sell in 6 months those US dollars. And so they're going to buy that put option at a strike price of 95 euros, 0.95 euros per dollar, with a premium of 0.02 euros per US dollar. And it's important to remember in this step that when we're talking about the premium, we need to take into account the future value of that premium. So we'll calculate here the 30 million US dollars times that strike price, 0.95, and get 28,500,000 euros. And we also need to take into account 30 million times 0.02. That's that 0.02 per US dollar. So 30 million US dollars times 0.02 times 1.025. We're using that, again, that Eurozone 6-month interest rate to get the future value of the premium. And that gives us 615,000 euros. Step 2 is then to just subtract off that future value of the premium to arrive at the expected euro proceeds of the put option. So fairly straightforward step here. You're just subtracting 615 from 28.5 to get 27,885,000 euros. And that's the guaranteed value, or the expected euro proceeds from put options here. The last question asks us at what future spot exchange rate do you think Airbus will be indifferent between the option and the money market hedge? So what we're doing here is just calculating a break-even spot rate. It may be easier to think about it that way. Step one is to determine the guaranteed value of the money market hedge using the rates and information that we have already been given. So luckily for us, that was actually calculated up here in question 3 when we were calculating the value of the money market hedge. It's just the 28 million right there. And then step 2 is to determine what spot rate, this is really where we're getting our answer, what spot rate in 6 months would give us that same value as the money market hedge. And the formula to do that is as follows. So you'll take the receivable, which in our case is 30 million, times the spot rate, and that's going to be the variable we're solving for here, minus the future value of the premium, which again is 615,000 euros, and set that equal to the value of the money market hedge. And once we plug all those numbers in, it spits us out a spot rate of 0.9683 euros per dollar. And that would be the spot rate that we would be indifferent between the put option and the money market hedge. So just a little bit more conceptual breakdown and explanation of the break-even spot rate. It does help us to choose between different hedging strategies. So if we anticipate a certain spot rate in the future, we'll use the break-even analysis to choose a hedging strategy, whether it's a forward contract or money market or a put option. It can also be used to compare the put option to the forward contract as well, which I just mentioned. So same equation, you're just using different numbers since the forward contract is going to give you a different value. So for example, the right side of this equation would just be different. And for Airbus, in this case, the future break-even spot rate was calculated again to be 0.9683 euros per dollar. And at this rate, that's where we're indifferent at any spot rate greater than this. So if we were to go to 0.9684 euros per dollar, then the put option would be preferred. We're no longer indifferent. Anything below, even 0.9682, the spot rate at that would then have us prefer the money market hedge. And that is going to be all today, guys. I hope that covered everything and maybe clarified any questions that people may have had on that mini case or with hedging receivables as we head into this next unit. Thanks.